Hey everyone, it's another episode of In the Money with Amber Kanwar. Remember, all this month we are doing our swag giveaway. We've got our In the Money hats, finally. We've got our EBITDA hats, the classics, and we have our In the Money mugs, all thanks to our partners at Raymond James. And it's so easy to get a piece of swag. All you have to do is be a subscriber anywhere that you're listening or watching and comment on a video. This video, for example, and each episode we will pick a winner. Now, in this episode, we've got a very special interview with Adam Waterous. He's the head of Strathcona. And if you've been paying attention to energy news recently, you know that Strathcona is in hot pursuit of MEG Energy. And this week, they just increased their bid. And still, they are naysayers on the deal. I go through each of the points, point by point, with Adam Waterous, and we get his take on why he still thinks he's the best owner for MEG. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Adam Waterous, thank you so much for joining me.
Nice to be here, Amber.
You're a returning guest. I interviewed you in the summer.
I know, and that was such a good experience. I said, you came to my town. I thought if I'm in your town, I'll come see you.
Well, I appreciate it, and you come bearing news, which is always great for a podcast. Backstory, of course, is you're in hot pursuit of MEG Energy, hostile bid. We talked about it in the summer when you were the only bid on the table. And of course, now Cenovus has come in, and just this week, you increased your offer. Talk to me about why you increased it and what the features are of this offer. Like, what prompted this change?
Sure. Why don't I start with the features, and then that can kind of go to, why make the change. So what we did is we converted our transaction from mostly shares and some cash to all shares. And specifically, what we're proposing is that MEG shareholders would receive 0.8 of a Strathcona share for every MEG share that they own. We also made clear how we're going to distribute cash to our shareholders. We'd previously announced that Strathcona is going to distribute $2.142 billion in a special distribution to Strathcona shareholders. And
I believe you said that on our podcast in the summer.
I think we'll probably distribute something like $10 a share, something like that. And it was somewhat, broad in nature, and we're trying to really be very specific now. So you'll notice I said $2.142 billion. So that's a very specific
like a lawyer,
number.
A lawyer
it's
got
a
to
very
you.
specific number. So how we're, why we're, and what we're doing that is, well, geez, we've made this offer for MEG. What does that mean for if you're a MEG shareholder? Well, for MEG shareholders, we assume if they tender 100% for us, then the number of outstanding shares for Strathcona is going to go to about 410 million. And so that 2.142 billion works out to be about $5.22 a share for a MEG shareholder. For a Strathcona shareholder, MEG will get their proportionate 0.8 of that. Now, we might not be successful in acquiring MEG, and if we do, we're going to continue to distribute that $2.142 billion. in a special distribution, and that will work out to be $10 a share for each Strathcona share. So a very specific reference. And also, what's important is that Strathcona shareholders will have the opportunity to either take it in a dividend or in a return of capital. And return of capital, because we had sold, as we announced just before I saw you a couple of months ago, our Montney business. And because we've now sold our Montney business, we are giving shareholders the opportunity to take the distribution in return of capital, which effectively means that it'd be tax-free. And so we can give them that alternative.
I want to just double click on a point, and it's kind of technical, but you mentioned MEG shareholders would be eligible for the dividend at that 0.8 rate. So they are getting the special dividend as well if they tender to you.
If they tender, they will also be receiving their proportionate amount.
Okay, I'm going to let you give the sales pitch on why a MEG shareholder should tender to you as opposed to Cenovus. Right now on the table, your offer is higher than Cenovus offer. But as you mentioned, the nature of it is different. Yours is all stock. Theirs is all cash. Not all cash, but largely cash.
Sure. So there's essentially three reasons. The first, which is the most obvious, is it's a higher price. It was a good start. Stock prices move around a bit, but on our announcement, it hasn't really changed. It's about 11% higher than the Cenovus alternative. The second, though, is the nature of the consideration. In the case of Cenovus, it's largely a cash exit. It's 75% cash and the 25% shares of Cenovus. Ours is 100% shares. Now, why does this matter so much? Is that one of the things that we've learned since we talked 2 months ago is that Cenovus did make the offer and reached an agreement with the MEG board. And what that led to is a pricing by the market of the upside associated with a larger SAGD business buying MEG, meaning how much more incremental value could be realized on the MEG asset base if a larger SAGD business bought it. Now, I'd previously had said something, I would say, quite general. The reason why Strathcona was interested in buying MEG is that we as a larger SAGD business would be able to take advantage of MEG's asset base and realize economies of scale and operating synergies, in part by applying learnings that we've learned from other SAGD businesses that we have from a technical perspective and apply that to MEG, and that we'd be able to extract more value. That's all I really said. And this is a very technical, structural challenge. It wasn't because the executive team at MEG are dumb or lazy. It's that they have a structural impediment in realizing that value that only a larger SAGD business could use. Now, Cenovus, in their when they announced, took what I would describe as that general thesis of ours and went into great detail on it. And so they put out a deck. It's on Cenovus's website. And if you look at pages 5, 6, 7, 8, 9, 10, they go through in quite granular detail how Cenovus, by being a larger SAGD business, was going to be able to better develop and operate MEG. And to give you some sense on that, and we wholeheartedly agreed. But they gave a lot of detail. And to give your viewers some perspective on that, what Cenovus identified is that they could change how wells were placed. They'd place them farther apart. If you place them farther apart, you don't need as many wells. They would drill the wells longer. If you drill longer wells, you don't need as many. We were doing a very similar thing for Strathcona right now, so we can do the same thing. Cenovus identified they have what they describe redevelopment wells, which is basically having wells in a lower part of the zone to recover more resource. That's also something that Strathcona is already doing. Then they talked about identifying the opportunity to put more steam in the reservoir, generate more steam. One, by re-rating the steam generators, and then just putting in a new steam generator. All things that Strathcona would do too. But the only thing that Cenovus identified that we would not do, or would not be in a position to do, is be able to access lease line resource, and that there's a rule in the business that you can't drill within 100 meters of a lease line. And because they would share the lease line, they could get closer. Now, but why this ends up being important is that you only go close to the lease line when the asset's getting very late in life, where you've run out of locations. MEG's got tons of locations, so that's not a problem. Now, this has got a 50-year reserve life. They would be running out of locations decades from now. So essentially, we thought we could capture all or virtually all of those synergies. Now, why that ended up being really important, and this is going back to your question, why the difference in consideration is all that upside got identified by Cenovus and got priced into their acquisition. Now, how does this work? Now, this is a little nerdy for M&A, okay? This is actually super important and can be applied for a lot of other things. Is that if you look, there's two different ways to think about a transaction. Who's the winner? Is it the buyer or is it the seller in a transaction? Well, it's actually very easy to find out. And that is, look at what happens to the buyer's share price after the announcement of a transaction. Now, we put this in a presentation when we announced our new bid, is that if you look over the last 20 years in Canada, there have been 102 transactions with one public company buying another public company of size more than 500 million. 102. Now, and in those cases, of those 102, the median, what typically happens is that the buyer's share price goes down 2%. Now, in the case of Cenovus, this is in the following 5 days. Mm-hmm. In the case of Cenovus, it went up 10%. That's only half the story. What you also have to look at is, okay, so it's gone up, and sometimes these go down. So it's gone up, but then you have to think about, now what percent of that market cap value, what does that lead to as a percentage of the target? So if a company buys something for $100, what typically happens on a median basis, 102 transactions, the value of the buyer's stock goes down $5. So when you actually look at the net effective price to the buyer of the acquisition, it's $105. Now, in the case of Cenovus buying MEG, the stock price of Cenovus went up the equivalent of 56% of the purchase price of MEG, which was $3.9 billion. So there was $3.9 billion left on the table by MEG's shareholders, which out of 102 transactions, all the transactions in the last 20 years, was the most amount of money, 56%, on a percentage basis, of any transaction in Canada. Meaning, go ahead.
Well, I just want to, because you've thrown so much information for us to think about, but if I were to distill it, you're saying operationally we can do most of what Cenovus can do. And they're obviously coming away stealing it because their stock has done better. I know that that's your argument. It's written, as you said, you've made presentations about this. So I've had a chance to talk to people about that argument.
Sure.
And they have said it's kind of unfair for two reasons. One, Cenovus is also in the process of getting its act together. Its downstream business, is finally doing well. They just did an asset sale that gives them more than $1 billion in cash that will probably help fund MEG if they're successful, but also goes to pay down debt. So in a lot of ways, Cenovus is getting their act together, but also a Cenovus and MEG transaction, sort of like the Ross and Rachel, right? Everybody has been waiting for these two to get together. And so the fact that it was happening, it was almost a catalyst that people were already waiting for. So that all this to say, it's not necessarily fair to say that they're getting it for a steal, that there are other factors at play. That's why Cenovus did well.
Well, just for the math, just so we're clear, this isn't like, oh, they've been getting better over the last 12 to 18 months and they lost their way. And over the last, year or two, things are better. This is just the 5 days following the acquisition. That's all the math is always about it. So this really isn't like, other externalities. This was all before their most recent, which was announced today, that they're selling some refinery businesses. So this was already incorporated into the math. So put another way, is the $3.9 billion, I don't think that that's in discussion. What's in discussion is, okay, how are you going to realize that if you're a MEG shareholder? So MEG shareholders can't realize that on their own. They don't have the technical capability. You got to be part of a bigger business, either at Strathcona or Cenovus on it. How do you realize it? Well, here's the challenge, is that the Cenovus proposal is 75% cash, 25% shares. And so that means that on a pro forma basis, MEG shareholders will own 4% of Cenovus. So they will have the opportunity to get 4% of the $3.9 billion. In our case, MEG shareholders will own 43% of Strathcona going forward of the $3.9 billion that's been left on the table. So if you're a MEG shareholder, you have 10 times the opportunity to get what has been left on the table by the MEG board.
Thank you to our partners at ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. You're talking to shareholders. You're socializing this idea. That's why you're in Toronto. And I'm sure your calendar is loaded with meetings. What's the feedback that you're getting? Do they like this? And do you feel like in the end, or at this point, a couple days in from announcing, you have a good chance of getting the votes?
Well, we've had a chance for a couple of weeks now to speak to MEG shareholders following the Cenovus announcement. And in that time, I have not spoken to a single MEG shareholder who is happy with the MEG board agreement with Cenovus. Not surprisingly, because what's been identified by this huge amount of upside that was left on the table. And by the way, just as a quick background, how does $3.9 billion get left on the table? Why is this? Because having upside in a transaction is not unusual. What is unusual is the selling shareholder not receiving it. Now, why is that? Well, it's because the MEG board only got one other bid from Strathcona. It was from Cenovus. And typically what happens when you get another bid is you play the two parties off each other. You get one party to sort of crank up another. So, they started at 100, you go to 110, then they go to 120, then you go to 130, and you crank it up, and you squeeze down that upside, so you deliver it to your own shareholders. MEG's board instead elected never to speak to Strathcona, never spoke to us the entire time. So we're not able to inject any competitive tension into the process. Instead, just handed the transaction as a gift to Cenovus. And when I say that, as handed it, no competitive tension. When it was announced, it was a take under. It was about $1 under the price of our bid at the time. It was under MEG's share price at the time. And so that's what was very, very unusual.
Now there is competitive tension, and MEG has acknowledged receipt, finally, of your offer. And so I guess the ball is in Cenovus court. Are they going to increase the bid? And then you have a decision to make. How do you think about how far you're willing to go to get MEG?
So let's go through some math. Okay, it's not a lot of math. Okay, but it's a little bit of math. Okay, so
classic investment banker.
It's not that. It's not quite. So the $3.9 billion has been left on the table by MEG shareholders. These are such big numbers. Like, what does that mean? Well, there's 254 million shares outstanding by MEG. That means there was $15.35 left on the table So
From like the $27 a share offer.
from the choice. So it's $27.25. You add $15.35, you get $42.60. I mean, put another way, it's theoretically, if Cenovus had originally paid $42.60, their stock should have theoretically stayed flat. Now, in fact, if MEG's boards had actually done its job and it just got the typical deal, where the stock was down 5% of the value it's being acquired, that's about another $1.40. Okay, so now it's around $44. So what MEG's shareholders were entitled to on a cash exit was $44. They were at $27.25. So that's the bigger than, so this is the bigger than a bread box.
But you just told me it should be a 4 handle. So where's your 4 handle offer?
So let's go through the math. So we're at 31. Today as we speak, we're at 31. Oh, I guess Cenovus goes to 33. Let's say that's what happens. It doesn't work. And the reason being is that offer, 25% shares, is only 4% of that gain. They can't make it up. So let's say, okay, Cenovus goes to 33 and it's 50% shares and it's 50% cash. Well, whoop-de-doo, you go from only 4% of Cenovus to 8%. Remember, you're trying to get back the $3.9 billion that's got left on the table. The only way for MEG shareholders to realize the value from their asset that they are selling, that only a bigger company can realize, is by taking shares.
I have several other areas of pushback in my canvassing of shareholders. So you've sort of stated your case mathematically.
Yep.
It doesn't make sense. You feel like you have the votes. It honestly sounds like if 4 handle is the right number, that MEG shareholders maybe aren't getting a fair shake either way. And I know you don't agree with that because you think they get to participate in Strathcona's upside, which we'll talk about what that is. But here are all the points. Are you ready?
Sure.
Okay. First one is, if you do the Strathcona deal, MEG shareholders, they get less liquidity, which is a problem with Strathcona. Assets that aren't similar quality to what MEG is, and less ability to buy back shares because, again, of the liquidity problem. These shareholders, they love share buybacks, and you'll be constrained in that. So those 3 factors are what's being highlighted as, maybe why, even if Strathcona is higher, those 3 things are problems.
Yeah, and I can understand you hearing that, and that's really because that is misinformation that has been advocated by the MEG board. And the reason being is they've said, oh, we'll have less liquidity. We won't be able to sell our MEG shares. They didn't understand. They lose no liquidity. Whatever liquidity that they currently have, I mean, that's the number of daily shares that trade. I'll give you a quick math on that. Strathcona trades about $5 million a day. MEG trades $60 million plus. The liquidity that the new business will have is additive. It's the 60 plus the 5. It's not less, it's more. Somehow, MEG's board made this representation as you're going to go from 60 to 5. It was just false.
One of the interesting things about how Strathcona is set up is, and the reason that there's less liquidity and people might not know that, is because it's held largely by your private equity firm, Waterous Energy Fund. And this has unearthed what some have said is a contradiction in some of your promises with MEG, because on one hand, I believe as of last year, 2024, you kind of promised members of the energy fund better liquidity, and presumably that would be done through selling shares. But then as part of your announcement to when you increase the offer for MEG, you announced that you'd be willing to enter a mutually acceptable lockup of shares, Waterous Energy Fund. So isn't that help us reconcile that? How does Waterous Energy Fund deliver liquidity at the same time that you're promising to kind of lock things up?
Well, we have the opportunity. Why we're offering a lockup, they said, oh, geez, you're worried about, you're just going to dump all your shares, and it's going to depress the shares. Well, the first thing I would say is we unwound our first partnership at the beginning of this year in January. Since that time, I think our stock's up 40%. So it seems like dumping the shares hasn't, if every time we dump shares, the stock goes up 40%, we think that sounds pretty good to us. So I think that wasn't really, it didn't really follow that. We are not under time pressure to provide liquidity. And that's why we said, geez, if this is something you're really concerned about, we're happy to talk about a lockup.
You don't have pressure from your LPs in the fund to deliver that.
We still have another more than 2 years to be able to provide full liquidity to our shareholders.
You mentioned your stock price going up, and you're absolutely right. Since our interview, Strathcona is up 30%. The TSX Oil Index is down a little bit since that time. And you know what? People find problems in anything. And so some people are finding a problem in that. You mentioned in July how your stock's trading at this discount. Now, of course, it has run up. And so that you're using this quote unquote inflated paper, which is your stock, to do a deal. And in this environment, with oil prices at $60, it's overvalued paper that's at risk.
So what's unusual about this transaction is that we have a bigger company taking over a smaller company. Strathcona is a larger company than MEG, not a lot bigger, but a bigger company. And what's super important when I talk about upside, one is just, hey, you own a larger share of the business going forward, you can take that. Second very important upside is that on a per share basis, this transaction is accretive to MEG shareholders. So that first of all, they get this premium, in terms of what it was. But the stock's traded, it started at 21. Okay, just as a refresher. So they're getting a premium. But the second is on all share basis going forward, depending on whether you look at cash flow or net asset value, on average, MEG shareholders are receiving accretion on a per share basis of about 25%. This is very unusual. Usually what happens in an M&A transaction, the seller gets a premium, but then they get diluted on a per share basis. So they're getting both benefits on it. Now, with respect to our asset base, and what's our margins on a per BOE basis are a little bit higher than MEG's. We think MEG's is excellent. We like the business. We don't like to tell them they got terrible assets. We think there's a lot of upside. But our margins are better. And we have a similar reserve life index, which is, ours is 50 years. Theirs is actually 52 years to be very precise. Both would be the longest in it. Now, the other thing that also ends up being relevant is, and by the way, to give you as a sense that, and we deal with some, we like the guys at Cenovus, we like the business very, very well, but we do have a very different business. They have because they've got a lot of non-oil sands assets, they've got refinery business, their margins are much lower than us. But what really counts is what is your total shareholder returns. Now, we started our business at Strathcona in January of 2017. Now, since then, if you look at the top 20 publicly traded oil and gas companies in Canada, we have had the highest total shareholder return, 303%, 18% on a compound annual basis. It's number one out of 20 companies. MEG, prior to us putting them in play, had earned 10% at that same time since January of 2017. Cenovus had earned 2%. They didn't beat inflation. Now, that's not negative I don't want to be negative on Cenovus, but they've had a very challenged business. So but one of the things that
you were also at zero in 2017, so there's been a lot more growth.
Yeah, so we've had massive returns, super high growth. Sounds pretty good to me so far, okay?
You know what? It's so funny that even on the special dividend, people find a way to complain. And I think it's actually a big reason that the stock has done so well, because that's such a huge number, $10 per share. But then, I hear people saying on the other side, well, if you're such a growth engine that grows by acquisition, why are you blowing us all on a special dividend? What are you saying about your ability to grow by acquisitions, whether you get MEG or you don't, by doing these special dividends?
Yeah, so let's talk about our base business plan. And we can talk more about MEG, but right now, Our base case business plan is all publicly disclosed. We're producing about 120,000 barrels a day today. We're going to organically grow over the next 5 years to 195,000 barrels a day. This is 100% oil. That's going to shrink our reserve life index from about 50 years to something in the high 20s. So one of the very longest longest in the sector. That 8% compound annual rate growth is the fastest growth in the North American oil and gas business for any company over 100,000 barrels a day. So we have now MEG is growing much slower. It's growing from 100,000 to 130,000 barrels a day. It's all been publicly disclosed. So what we will be on a combined basis will go from about 220,000 barrels a day day one to 325,000 barrels a day. But our growth will be reduced a bit from 8% to 7% because MEG's not growing quite as fast as we are. What's also important is, well, we have made lots of acquisitions. We've also had a lot of organic growth. Approximately 60% of Strathcona's existing production are from wells that we've drilled. And we've bought things, but then we exploit them better.
So are you saying the M&A is not the key thing everybody thinks?
Well, right now, our base plan, we always like to say plan A is just to grow from 120 to 195,000. Plan A plus is to actually acquire MEG and grow from 220 to 325. So M&A is definitely been very useful, and that's one of the reasons why we like MEG. And because what we've obviously seen, we've been very successful in being able to take single play companies who have not been who are impeded in being able to optimize that asset because it's a single play, and being able to use economies of scale to better exploit the asset.
Are there other options for M&A other than MEG? You don't have to name them, even though that'd be nice if you did.
I would say we have. I'll answer a couple of ways.
Can you answer it directly?
Yeah, I'll answer a couple of ways, and then this will maybe lead to how you think about things. So a fair question is, geez, you guys over since we started this business 8.5 years ago, you're using, your total shareholder return has been 18% compound annual. Number one of the top 20 oil and gas companies. What's the trick? What's the secret? What's the Jedi mind trick? Well, we have been very open about this, and that is what we have seen is that single play companies, which are the dominant operating strategy today, and why are they the dominant? I want to be in one little tiny piece of the basin. Why did that become such a popular operating strategy? There's a very good reason, is that's the easiest company to sell. So if you want to build, a 20, 30, 40, 50,000 barrel a day business, be really focused. Don't be all over the place. Be really focused. Makes sense. It just so happens that's not the ideal way to actually maximize the value on that asset. What you want to be able to have is similar assets, not different types of assets, like, I'll have something offshore or, in Uganda or something. No, you want something very similar so your technical team can apply economies of scale, operating synergies to it. And so what we simply identified 8.5 years ago is there's a lot of single play companies who are doing fine on their own, but could be a lot better if they were consolidated into what we call a core area consolidation strategy to be able to be better exploited. And MEG, to give you a sense, this is not a new idea of ours. Like this will be our 6th SAGD business that Waterous Energy Fund has acquired.
But you got into the Montney, you got into the Duvernay, so your geographic focus is narrowed. That has to mean that there are fewer options for.
So one of the reasons why we sold the Montney, we really like the Montney. We're very proud of the Montney. We grew from 5,000 BOEs a day to 75,000 BOEs a day before we sold it. Sold it very profitably. We sold it in 3 separate transactions to the 3 largest natural gas producers in Canada. And we think actually they're going to do extremely well with them. We think that they will do a better job in exploiting those assets, growing them, have better returns than we would. Geez, why? Are we dumb and lazy? No, they're bigger. They have the capability of being able to use economies of scale on those particular assets. So what we look for are assets and businesses that are very similar in nature to what we already have, that we can apply the technical learnings, the buying power, to be able to enhance performance. I mean, what's great about this is every time you add one, not only do you improve your the business you're buying. Like we think, what's really nifty about this is, hey, we see there's $3.9 billion in upside in MEG, but we actually think if we buy MEG, the rest of our business is going to be better too. This is very important to understand. Now, why is that important? Is that ends up being because we can apply the learnings from MEG. We think we'll learn some things from MEG as well. It's not just a one-way street on it. And our overall business ends up performing well. So we look for, to answer your question about M&A, so we look for, the old line about, hey, do you have any more sisters at home? That's what.
So yes, I think the answer to that was yes. Even with special dividends, M&A is still alive as a strategy.
And by the way, special dividends, any question about that is, we've generally, how much we distribute is generally targeted to a leverage ratio. We've generally kept, as we built Strathcona, we kept leverage low, generally 1 to 2 times debt to EBITDA. Post this special distribution, Strathcona will be levered about 1.1 times debt to EBITDA at $60 WTI. And so it really gets driven by, what kind of comfort level we have as for an appropriate leverage ratio.
I keep thinking about the fact that you told me this like 4-handle number. You keep saying $4 billion left on the table. If a 4-handle comes out, is that it? It's over, right? You could do that. And it would be over, and you'd get MEG, and you get all those wonderful things.
So what we think, I'm trying to always put yourself in the other guy's shoes. When trying to make a deal is, what would I want if I was a MEG shareholder? I'd say, geez, I've got this asset base. I can't exploit it myself, but I know someone else, a bigger company, could really squeeze a lot more juice out of the lemon. How can I get as much of that juice out of the lemon as possible? Well, it's by taking shares, and is able to reason, as opposed to I'm just going to crystallize for a specific price and then exit. And I think a lot of the MEG shareholders are going to say, just, I don't want to crystallize right now.
You're doing this at a time where oil is just down in the dumps. Sentiment is low. Eric Nuttall, for goodness sake, is bearish on oil. And so, I guess people also have the option of MEG as just a standalone.
So MEG as a standalone was a $21 share stock. So I don't think anyone who's a MEG shareholder wants to go back to $21. Meaning what has been reflected is the opportunity that Strathcona sees and Cenovus sees to be able to realize incremental value.
And is that value, are you using today's numbers, like $60 oil? Are you swinging and betting we get up to 80? I know one of your slides used 80. I think that was as an optimistic scenario, but you're not just a banker anymore. You actually have to own these assets and operate them. So the numbers do matter. What are your assumptions when you're making this deal about oil prices?
So 2 thoughts. Let's go back to the returns we've earned to date. I said, geez, we've earned 18% compound annual total shareholder returns over the 8.5 years. And I think part of the punchline in that is, and that's with oil in the low 60s. It's like, oh, well, you bought all this stuff in the 50s, now oil's $100. And no, that's with oil in the low 60s. How have we done that? It's because we've been better at exploiting the assets. We've got this core area consolidation, squeezing more juice from the lemon is very effective with the strategy. Now, let's talk about who's kind of the typical MEG shareholder. Well, it's a pure oil company with a very long reserve life, just like Strathcona. People who buy MEG shareholders are bullish on oil and think oil is going to be higher at some point in the future than it is now.
It strikes me that during this whole process, you've had almost no dialogue with MEG. At the same time that they've had to go through this process of selling themselves. And I can't help but ask if it feels personal? I know you've been in the energy sector for a very long time. Do you feel like an outsider? Do you go to the same clubs that they go to? It's a small town. So it seems personal the way that they are sort of ignoring you.
Here's what I'd say. What's happened? Okay.
Oh, just answer the question.
Okay, so here's what's happened, because it's helpful to have the context to understand my personal reaction.
Okay.
What's happened is we made a proposal April 28th privately, tried to get engagement. I got 2 weeks later got a 2-line email, not interested. Not like, hey, do you have any more money? Do you have to maybe we got a real sucker on the line here and we can, nothing. That was our last dialogue with the company, was the 2-line 4 months ago.
Do you know anyone there? You must know.
And so it's not like, it's not like, I guess I must have said something offensive to someone at some time. There's been no much. Now, what tends to happen, and I'm somewhat sympathetic to the human condition of, because they wouldn't even talk to us. We said, well, we'll have to go direct to shareholders. I'm not a real big fan of the term hostile takeover. Hostile to who? The shareholders. Every single shareholder that I've ever talked to is so glad we made this offer, because it's like, oh, thank goodness, we've got something to talk about. And so then we just go public. Since the time, no dialogue. So and they make all these claims like, oh, well, we're worried about you selling shares. Well, just ask me. How about a lockup? Or we're worried about, oh, we don't like your assets so much. Why would you not like our assets? You've never asked us about the assets on it. So there's been absolutely no dialogue. Now, what happens is that, and I'm sympathetic to this from a human perspective, is that we went public with our offer. And the common term is we put the company in play, which forced them to put the company up for sale. And when the company gets put up for sale, when they didn't want to be put for sale, people don't like to be, put in that position. Now, what's really important is that the boards of directors of these public companies have a fiduciary responsibility to their first priority needs to be their shareholders, not themselves. Now, when a company gets put into play, it's not surprisingly that there's going to be some job displacement at the board level. That's just the way it is. Now, people need to, when you're a director, you've got a fiduciary duty to put that beside. Now, the fact pattern here is grim. This is what happened. We made an offer. The board refused to engage with us. They accepted a lower price than ours. They provided a break fee to that buyer when our bid was out there. Now, in the United States, if this company was headquartered in the United States, I think there would be a high probability that there would be numerous shareholder lawsuits against the board based on their conduct to date. Now, why does that make it relevant? Well, people are always saying, oh, we can't get any capital into Canada. Oh, no one wants to list on the Toronto Stock Exchange. You can't get any new listings. Well, one of the reasons being is, what recourse do shareholders have in Canada relative to the United States when you have a badly behaving board? It's a problem. Meaning, I think that the conduct of this board, leaving $3.9 billion on the table, everybody now knows the number, never engaging with the original party and doing a take under with a break fee, the fiduciary duty here is grim. The drama around a badly behaving board, it can be frustrating. It's something that we work through because we're just going direct. We are bypassing the board and going directly to shareholders. Having said that, the poor corporate governance of this board leaving more money on the table than any transaction in Canada in the last 20 years is going to be taught in business schools in the future as what not to do for boards.
Unless there's a higher offer that comes out, then maybe not.
No. You can't unsee what's gone on.
The final question that I have is about, you do really telegraph your playbook. You're actually not secretive about it at all. And I do encourage people to read what you said in 2017 about what you were going to do, because you pretty much did exactly that. So I think we're going to have more interviews, Adam. I hope that we are. After
me too. Me too.
This hour. So, let's say we catch up in 2 years. And I don't know how MEG's going to shake out. Mm-hmm. You seem pretty confident you're going to get it, but what is Strathcona in 2 years? What have you done? What have you?
Well, what we are
you?
planning on is executing our business plan of trying to organically grow the business 8% a year. That's our base case. I would say I am extremely bullish on the broader oil and gas sector in Canada. It has been a challenge from a regulatory perspective over the last 10 years. And much of those regulatory challenges look to be substantially less going forward. Amber, as you may know, I've been pretty public for more than the last couple of years that I think there's the opportunity for Canada to double its oil and gas production over the next 15 years. That would take it from about 7.5 million BOEs a day to about 15 million BOEs a day. I'm quite optimistic that we can do it. That's part of Strathcona's business plan. I'm doing my share, and we think that there'll be other opportunities for other companies to have similar types of growth plans.
Adam, thank you so much for joining us. I appreciate the conversation and the willingness to take on some of these tough questions.
Always nice to see you, Amber.
That's Adam Waterous joining us of Strathcona and the Waterous Energy Fund. We'll catch you on the next episode. Hey, in the Money Gang, there's a special event happening in Toronto. If you're interested in investing or meeting me potentially, we've got Mike Larson of the Moneyshow. They put on investor shows around the world in North America, and they are coming to Toronto. Mike Larson is the editor-in-chief at the Moneyshow. Mike, thanks so much for being with me.
Yeah, Amber, thanks for having me. Glad to join.
So you guys have come to Toronto. You've come to Canada before.
Yes, we've been in Toronto hosting a show many, many years, about 20 years now, actually. And it's always a great time to get up here, get up to Toronto and have a nice mix of both US-focused and Canadian-focused experts and talk about, what's going on from all perspectives, the economy, geopolitics, market sectors, a little bit of everything on the investing side, and a lot of trading education too. A lot of speakers who can help, whether you're trading stocks, options, ETFs, what have you. And whether you have short-term or long-term timeframes, we try to bring together experts with a little bit of background in everything. It's really kind of like I guess I describe it as a 2-day investor smorgasbord or buffet of education.
I was fortunate enough to go to the one in Miami. You have such a high caliber of guests, and yeah, they're sharing these insights. And kind of the best part is a lot of these speakers, they stick around. And so if you've got a question that they didn't address in the presentation, it's like really conducive to meet and greet and sort of networking with some of these people that you might see on TV, that you might, have written or have read what they've written.
Yeah, absolutely. We try not to do the velvet rope thing here. I mean, we've got speakers that come from a wide range of disciplines. They're economists, they're strategists, they're authors, they're traders and what have you. But they're not just speaking at you from a podium. You have the chance to do meet and greets, book signings with some of them, have a conversation at the networking reception at the end of day one to talk about some of the ideas they shared. I mean, it really is designed to, again, put you up close and personal with people you may have seen on TV, you may have heard their podcast for that matter. But otherwise want to, really ask questions, get answers, and know what to do with your portfolio.
Yes, I'm so excited because I get to be one of the presenters. I'm so flattered that I was asked to present. I'm presenting on September 12th. It's a 2-day event, so September 12th and September 13th. And I imagine putting on these conferences for so many years and in different locations, Mike, you get a sense of like kind of the vibe that is out there in the markets right now? Because you've been doing it in good times and bad times. And right now is one of those odd market conditions where people seem super nervous. Like sentiment isn't insane, even though the markets are at record high. Like, how would you capture, what the vibe has been like for 2025? What are people trying to figure out this year?
No, you're absolutely right. I mean, it's been a great year for the TSX. It's outperformed the US S&P. Many foreign markets have outperformed US assets and so on. You have things like metals that have been phenomenal performers, whereas things like energy have tended to lag a little bit. But I think people are looking for opportunity. It's cautious optimism. I guess I wouldn't call it, that sort of 1999 vibe where everybody's all in. There is definitely some caution. There are concerns, whether it's about debts, whether it's about geopolitics, whether it's about tariffs, what have you. I mean, certainly there's been a lot in the news that I think has people concerned, especially more recently what we've seen on the jobs front, particularly in the US and the slowdown that was just reported there. So I think people are coming and looking for answers. They're looking for actionable things they can do with their portfolio. Still sort of tilted towards, finding profits, but definitely a little concern and a little thought about how to hedge, how to protect and diversify, versus just being sort of all in on the equity front.
So where do people get more information? How do they get tickets?
Sure. You can go to torontomoneyshow.com or just moneyshow.com and look under the live events tab. This is an event that's completely free to attend. You just register in advance, or even if you're not sure you can make it, but you show up, we'll get you taken care of on site. It's a great 2-day program. It's going to have a lot of information and actionable information at that. So we'd love to see you in Toronto. It's going to be a great time.
And one of your frequent presenters, Larry McDonald, was our first guest on season 2. And he's had a lot of great calls recently. So that's what we're talking about when it comes to the caliber of people that you can get to rub elbows with or rub shoulders with. Mike, thank you so much for joining me. Can't wait to see you when you're in Toronto.
Great, Amber. Thank you.